Good afternoon, ladies and gentlemen, and welcome to the IMMOTION Group results presentation. Throughout this meeting, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time using the Q&A tab situated on the right-hand side of your screen. The company may not be in a position to answer every question received during the meeting itself. However, the company review all questions submitted today and publish responses where it is appropriate to do so. These will be available via your Investor Meet company dashboard, and we will notify you by email when they are ready for your review. I'd also like to remind you that throughout this presentation you'll be in listen-only mode, and that this presentation will be recorded. Before we begin, we would like to submit the following poll, and if you would give that your kind attention, we would be most grateful. And I'd now like to hand over, if I may, to Martin Higginson, co-founder and Group CEO, David Marks, co-founder and Group Finance Director, and Dan Wortley, Company Secretary. Good afternoon to you all.
Yeah, good afternoon. Thanks very much for having us. Okay. So we've turned our cameras off just in order to people can see the presentation a little bit better, and I think it's far nicer than our ugly mugs. So listen, we'll get stuck straight into it. Talk about our interim results and talk about sort of where we are and where we're going, this year and beyond. Sorry, just bear with me. The wonders of technology. Hopefully you should be on slide 2. There you go. So, I mean, really, what we're going to talk about, we've had a very sort of strong sort of first half of the year. We've been very pleased. Quarter one was, we showed at about a £200,000 loss in quarter one. And really that bounce back in quarter two was as our sort of location-based sites opened up and gave us a break-even result, or as close as we can get for the H1 period, on revenues of about 2.8 million. So we're really pleased with where we've sort of started the year, and as we sort of moved into quarter three, we've seen profitability from April all the way through to September. So great position, outstanding quarter three, revenues of 3 million, EBITDA of about £600,000, and I think we look as though we're sort of reasonably well set for a strong quarter four. The home-based product, our Let's Explore Oceans product, is selling well and sales are increasing. Our Uvisan orders are coming through, and people will have seen hopefully this morning that we announced sort of 64 cabinets going into the NHS. So I think we're in a great position, profitable and cash generative for sort of H2. I think that really sets us up well for as we sort of march into sort of 2022 and beyond. So I'll just hand over to David, who'll talk a little bit about sort of the revenues and numbers around the H1 period.
Good afternoon, everyone. I mean, this clearly for us was a kind of landmark set of results. Very, very pleasing, given the impact the lockdown had on our business. And I think what we've seen in H1 and Q3 together is we've begun to see the true potential of the business that we had built and had kind of had our knees chopped away as the pandemic hit and shut all of our sites. So that's very, very gratifying. The recovery has been led, as Martin said, since March, mainly by our location-based business, and by any measure, it's posted kind of record results. As we move from sort of Q2 onwards, year to date, including Q3, it's produced 4.6 million of revenues. And just to give that some context, 2019, which is the last full year that we traded, that location-based business reported revenues of 2.8 million. So I think you're really seeing the business come of age. Just a few sort of bits and pieces on the P&L that I thought might be worth touching on. And we've seen some comments and questions from investors. First of all, in terms of the gross profit was £1 million, but essentially all of that gross profit came from the location-based business. So it actually produced gross profit of £1 million on 2.3 million of revenue. So whilst the overall gross profit margin was 36%, that business produced 43%. and we would normally expect that to do a little bit better. It was pulled back by the fact that we had a number of our own operations with some fixed costs that clearly weren't trading in the first few months of the year. Just to clear up one or two sort of questions that have arisen, there has been some confusion between our cost base and cost of sales. And just for the avoidance of doubt, in our location-based business, the way that we measure gross profit is the gross revenue, which is effectively the ticket sales on the site, excluding any sales taxes or VAT, less the partner's share. So just to repeat, 100% of the revenue from the site, excluding taxes and VAT, goes through our revenue line. And from that is subtracted the partner share. And that's been consistent since we IPO'd the business. Martin and I have seen chat that suggested we've got 800,000 a month of expenses, and I think that came from a confusion between what was overhead and what was cost of sales. And indeed, you can see the admin expenses, which are effectively the fixed operating costs of our business, in the half were 1.4 million, which averaged around 235,000 a month. And that's kind of where we are on a run rate basis. We may see that creep up a bit with some variable elements that are kind of driven by increased activity, such as attending conferences and travel and the like. Another thing that I just wanted to touch on, a number of investors have raised the question of, you talk a lot about EBITDA, are you actually ever going to make any money after depreciation and amortization? I think just to give a bit of context, when we IPO'd the business, it was a very new business in a kind of nascent sector that we were almost creating ourselves from scratch. And we didn't have a lot of experience of the equipment. So we effectively took the view that we thought be very, very prudent and write all of our equipment and our content off over 3 years. It's very apparent to us as a business with the benefit of experience that most of our equipment, the motion platforms in particular, which are the bulk of the hardware cost of our installations, have probably got a life with maintenance of 5 to 10 years. So the depreciation and amortization charge is really very unflattering compared to the kind of lifetime that we expect to see from the equipment. And that is probably something that my team will be talking to the auditors about in the context of the full year results, because people rightly are asking, when are you going to get into kind of full PBT normalized profit? And I think that's a fair question, but I think we have to some extent, through trying to be sort of very prudent, done ourselves somewhat of a disservice. So they were the kind of main things I wanted to touch on the P&L. Just moving to the cash flow. So the overview of we started the year with 1.6 million of cash in the tin. The net cash outflow in the business, net of everything, was £1 million, leaving us at the half year with 0.6 million. Now, I think it's very important to understand the context of the cash outflow. And in the top half of that slide, you can see we start with the EBITDA, which is the break-even outcome. The real feature of the first half's cash flow was the very significant cash outflow from working capital movements. And effectively, if you think about it, from a very, very low level of activity at the end of 2020, we effectively were rebuilding our revenues, and effectively the debtors that go with rebuilding your revenues. So we saw between trade receivables and other prepayments, we saw 600,000 movement effectively over the period, which is totally to be expected and natural given the kind of dramatic regrowth and the activity of the business as we went through Q2 and into Q3. And we had we had some, like I think probably most companies out there, we had some element of catch up on our payables, and we've paid off everything that we owed to HMRC, and we had an agreement with HMRC. We've honoured that and paid that all off. So we're in pretty good shape with a pretty clean balance sheet. The other items in the cash flow were 300,000 of effectively capital expenditure between tangible and intangible, and the split is set out there. And the balance was the net from the small share placing that we did earlier in the year, less loan repayments and a small additional loan that was received from the US government. I think one of the things that I think we want to emphasize today is we're really expecting a very successful, profitable and cash generative H2. And you can begin to see the impact of the working capital growth in H1 beginning to unwind, because as of today, we're sitting with near £1 million of cash as we begin, if you think about it, to collect the residue of those debtors that reflect the very, very strong trading that we had in the out-of-home business over the summer months.
Thanks, David. I'll just move to the next slide. So really the outlook for sort of H2 we think is very, very good indeed. We've had an outstanding Q3, as David alluded to, revenue of 3 million, EBITDA of sort of £600,000. I think that really does bode well as we move into Q4. Obviously, the sort of winter months, kids being back at school, we see a quieter season for the location-based entertainment, but there's still plenty of scale there. And I think, as we said in our statement, there's enough sort of gross profit being generated to cover virtually all of our costs, if not all of our sort of operating costs. We're expecting a strong performance from our home-based entertainment division. We're seeing revenues and sales pick up strongly. We've got and put in place distribution centres around the world. So we're now selling in Australia, New Zealand, UK, obviously, and US and Canada. We've got 30,000 packs. There was some comments that could we not have done more. I think what we did is we took a prudent view. I mean, our main aim this year, or at the beginning of this year, and certainly through last year, was to make sure that we survived and to make sure that we're in a position to start growing the business. So we bought the stock ahead of ourselves, of what we knew we comfortably could sell, and I think it's not the worst position to be in if we sell out of that, making a good profit. Our average order value is north of £80, and we're seeing very positive margins, and we're hoping that those margins will get better as we get nearer the Christmas period. So in terms of Uvisan, I spoke before about, great order book. We've had sold 64 cabinets into the NHS, which I think is really sort of, testament to the team and what they've achieved in building the cabinets. And we've got, good sales coming out of Australia through one of our distributors. It's still early days, but we're building the reseller network. We're seeing very, very strong growth. And I think, you can see by some of the counterparties that we're selling into, that we're selling into the right audience. And I think, we've had recognition from Microsoft, same from Hewlett Packard. So we've got a great product out there. It's now a case of building on that, using the cash that it generates. That will help in H2, and then that will really start underpinning our growth as we move into 2022. Let me just, sorry about this, just try to get the next slide. So just looking at our location-based entertainment division in a little bit more detail, revenues in Q1 just under £600,000. Q2, you'll see as the site started opening, it bounced back with a vengeance, 1.7 million, and Q3 2.3 million. So we've done over £4.5 million so far. The recovery has been absolutely fantastic. We're thrilled. We've got 44 of the 51 sites now up and running and fully trading. We're still in lockdown in Australia, but all of the sites that are open, they're trading very well. 7 new locations. So we actually installed 64 headsets during that sort of COVID period. Clearwater was a clear exemplar in that. And it was another theatre style installation. And I think as we move forward, we're seeing more and more sort of emphasis on our theatre installations. You can see on the right of the picture the theatre there at Mandalay Bay, and it's these type of installations that we want to do more of. And it really sort of underpins, we've touched on this before, how we are a tipping point business. That every new site that we open, that flows to effectively free cash into the business. So all our costs are covered. Any sites that we've got the CapEx that we've got to install those sites, but we are seeing good payback, and we're seeing payback in normally sort of sub 12 months on our new installations. So we're thrilled. We've got new products coming in terms of a new experience for the zoo market. We think that's a huge opportunity for us as we move forward. The zoo market's much bigger than the aquarium market. The product that we've got, I think, is very much at the sort of bleeding edge of conservation. It's another world first. I've mentioned that before, but it really will position us well in terms of allowing zoo visitors the opportunity to see animals in their natural environment that they just cannot see in those zoos. So I think as that market, the zoo and aquarium market, develops, I think us becoming an integral part of these faculties will really position us well, not only for 2022, but for many years going forward. So we think we've got a very winning formula, and there are lots and lots of growth opportunities here for us. So just in terms of our home-based entertainment, we saw reasonable revenues in H1. We were never expecting massive revenues. The price of the product and the design of the product aimed at the younger audience was always very much around the sort of Q4 period, but still quite good. You can see revenues in Q3 have grown. So H1 300,000, Q3 $500,000, and we expect to see rapid growth on that as we enter Q4. We've got the supply chain sort of sorted. I touched on that before. We're in Amazon. We are doing more and more sort of market testing and just sort of understanding the market. But as we get into Q4, focus very much on sort of US, Canada, Australia, and of course, we continue to sell and see increasing sales in the UK. So we're looking at selling about 28,000 units of stock in Q4. Average order value at the moment is running north of 80 quid, which should deliver strong margins. As we get into the Q4 period, we're seeing our cost per acquisition, our cost per sale falls as intent increases from people looking for sort of Christmas gifts. And I think this year, with the sort of state of the world, I think we are well positioned. Still some logistical challenges, but nothing that is causing us any sleepless nights. And I think the fact that we've got stock and able to supply that stock into customers should position us very well for what we expect will be a busy period. One of the feedback, or the big feedback we got from Let's Explore Oceans when we launched it last year, and we questioned our customers, was, when are you going to give us more content? When are you going to expand the sort of the verticals that you're in? So we took that feedback. Obviously, our main focus earlier on this year was making sure that the location-based sites were open. That was our primary focus, and you can see that we delivered on that. So I know there was some sort of criticism about not getting things launched early enough, and I think as a team we've had to sort of prioritize. A lot of our business we've effectively had to get out of mothballs. And we've had to make sure that not only works, having had sites closed down for over 12 months, we've got to make sure it works, it's operational, and we could actually get out of the gates running, which we clearly did. So for the sort of, as we moved into sort of Q2 and Q3, we started listening, and the sort of the home-based team started looking at how could we improve our offering. And I think one was about adding more channels. Two was about putting a product out there that was more competitively priced, so that it wasn't just a Q4 product, it was an all year round product. It was an impulse buy. So Zodiac will be soft launched, beta launched in Q4 of this year. It is very much aimed at a much wider market. It's got 7 channels. And I think if you think about this as sort of a Netflix, so you can watch video in VR on a headset. So the Zodiac comes with a headset. It comes with 7 channels. It's got a number of videos that you can watch free of charge, and it's then got additional videos that you can rent for a low cost amount. So really, this is about building recurring revenues. We think we've got the price right. We've obviously got to test it. We've got to tread carefully in this market, but we do see there's sort of sizable opportunities to create something that's an all-round product with recurring revenues. So as we move to Uvisan, I'm just going to head over to David because he's picked up the mantle very much on this and has been driving the team hard to deliver the success that we're now starting to enjoy.
Just in case there's some listeners not familiar, we set Uvisan up really to meet our own needs originally. When the pandemic hit, obviously having a business with hundreds and thousands of people using headsets as a core part of the experience, our concern was how do we very rapidly disinfect headsets at our location-based installations, and we designed and sourced the Uvisan cabinet to meet that need initially. It became apparent that there was demand from other people with similar businesses, and when I got involved in the business, really at the turn of the year, I kind of took the view, look, either this is an internal service or we actually try and grow this into a proper business. There's no point doing sort of something in between. So the path that we took was, and we've got a small team. We don't want to invest in a huge team or a call center or anything like that. So we kind of took the decision, A, to price up because there was very little competing product, and B, having done that and having seen the demand was still there, we were comfortable that would allow us to have a reseller and distributor network that could also get a decent share of economics. It was never going to be an overnight sensation, but I think we've made some very good progress. And I think that NHS order is a feather in the cap, and hopefully there'll be more to come there. We have an Australian distributor in situ now. The first container load of product is actually literally on the boat from China over to them at the moment, and I'm expecting there'll be a number of repeat orders through the year from them. We've got some boots on the ground in the States, and that's obviously the biggest market that we could go for. So I think we've made very, very good progress. We're going to expand the range because we've looked at going into a couple of large NHS type tenders, and there are probably a couple of other pieces of the jigsaw we could have in addition to the clean room product that you may have read about, which obviously is ideal for somewhere like an operating theatre. And the cabinets, we're going to add a couple of complementary products, which will A, widen the audience for the business anyway, and B, position us better to go into some of these huge NHS and other public sector tenders. And interestingly, in this UV space, it seems to be small companies that get the business, because obviously the public tenders you do get to see who's won them. So I think it's a kind of go big or go home strategy, but I think that's really a 2022. Let's see if we can really make that particular business come of age and transfer it from being a kind of cabinet reseller into being a specialist UV disinfection business that's got some real shareholder value.
Thanks, David. And I would add to that we're running a sort of just-in-time scenario with stock. We've designed these up with internal teams. We've really used the team while we were in the lockdown to sort of design this and make sure that we've got something that's very streamlined. So this is not massive investment from the company. This is something that is a cash generator, and then we can use that cash to invest in our sort of immersive entertainment business.
Yes, investment-wise, the requirements are light, a bit of stock, market capital, and we're leveraging resources across the group in terms of people and whatever. So we're not going to be investing a crazy amount of money.
So look, in conclusion, we, as I said and I said before, the main aim coming out of the pandemic was to make sure that we came out, not only that we survived, but we came out of this leaner, meaner and fitter. And I think we've definitely done that. I think the entrepreneurial spirit is really testament to the team. We've had an amazing location-based sort of recovery, which has been great. We've got 6 months of consecutive profits under our belt, which is a fantastic place to be in. And I think if we both look back to sort of 12 months ago, when the business world was very uncertain, we'd have taken that all day long. We really have the entire team got their head down and actually really worked hard to deliver. Not was only an outstanding summer, having as I said, brought these things out of mothballs, but to continue that growth into quarter 3. Our core location-based business is growing. We've got lots of inbound inquiries, and it's now about doing the diligence with those partners to really make sure that we install our next sort of set of installs in the right locations where they've got footfall. I think the good thing about our focus really on the aquarium and now the zoo market is that those audiences, their footfall is pretty constant. If you look back over the last sort of 10 years, most of the bigger zoos have got fairly constant footfall year in, year out. And we can tap into that, whether it be on a clip-off ticket or whether it be on an upsell. We can really tap into that and start being able to sort of predict the revenues from that business. Our home-based entertainment business and Uvisan have both been almost accidental heroes that have both been born out of the pandemic, but both have contributed and continue to contribute and will contribute strongly as we move into sort of the quarter 4 period. So, second half of the year, very profitable, cash generation. It really is about the group coming of age. We feel that we've actually, reached the point where we were, I think, destined to reach probably 18 months ago. Unfortunately, things out of our hands, but we've managed the ship through those stormy waters and come out the other side. So that sort of concludes our presentation. I'm going to open it up for questions now. We're happy to answer as much as we can. There may be some things that may be commercially sensitive, but wherever possible, we will answer all the questions that you raise.
That's great. Martin, David, thank you very much indeed for updating investors this afternoon. Ladies and gentlemen, please do continue to submit your questions using the Q&A tab situated on the right-hand corner of your screen. But just while the guys take a few moments to review the investor questions submitted already, I'd like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your Investor Meet company dashboard. I'd also like to remind you that your feedback is important to the company, and immediately after this presentation has ended, we'll redirect you for the opportunity to provide feedback in order that the company can better understand your views and expectations. Apologies if there is the occasional metallic breakup in the sound during this call, but so far so good, and we'll continue on this line. Investors had the ability to pre-submit questions. We received a number of those, and I thought we'd start the Q&A off with those. So perhaps if I could start with the following, which reads as follows: when will IMMOTION Group have content available for the zoo market, and when do they expect to sign their first contract?
Okay, so in terms of when we want content ready, we've been out filming in Rwanda literally over the last few weeks. The team are now back in the US. They're pulling all that content together. We will launch that at a trade show called IAPA in November. And we expect, and we're already in talks with a number of zoos. We're in advanced talks with some larger zoos, and we would expect that we will have an installation of size in the first quarter of 2022.
Thank you very much indeed. How many of the Let's Explore Oceans do IMMOTION Group plan to sell in the fourth quarter?
Well, as we said in our thing, we've got about 30,000. We sold some of those. So if you assume about 28,000 will get sold in quarter 4, and we're looking at sort of an average order value on a global basis of north of £80.
That's great. And then the final question, which again I think you may have touched on, is have you been affected by the global shortage of computer chips?
The simple answer is no. One of the things that we did some time ago is we reduced the need for computers or in our motion platforms. So we stripped them right back. Most of our motion platforms, through some proprietary piece of tech that our team developed, actually can now run off one single tablet. So the site in Mandalay Bay, whilst you've got 36 motion platform seats, it actually all runs off one iPad. And that also allows us, we can tap in and see any diagnostics remotely. So we've developed proprietary pieces of tech that make us less reliant on sort of individual computers and therefore individual chips.
That's great, thank you. I might just redirect you to the Q&A tab, if I may. There's quite a considerable number of questions that have come through from investors, so thank you to all those investors that have submitted questions today. Perhaps, Martin, David, I could hand back to you to read out those questions, perhaps even who it's from, and give a response where it is appropriate for you to do so.
Yeah, I mean, there's one from Anton, which I'll read, and then David can answer. The location-based entertainment business is capital intensive, involving a lot of equipment and setup costs. These costs are then depreciated in the accounts over 3 years. Whilst it's pleasing to see break even and monthly profits at the EBITDA level, this doesn't account for the capital cost of each installation, ignoring the exceptional 2020 and 2019 accounts that was significantly higher than the gross profit. Can you tell us what your expectations are for profit margins over the life of individual LBE installations, including all the capital and setup costs?
Wow. Okay, quite a number of issues there. I mean, I think we're in a very, very different place than we were in the sort of earlier part of the life of the business. I think I already alluded to earlier. I think in many ways we've done ourselves, somewhat of a disservice by trying to be too prudent and too cautious. I think a couple of things. Number one, we very heavily depreciated the cost of equipment that we've invested in. I think the net book value of our equipment is now 30% of the cost in our account. So what that means is we're actually seeing the depreciation amortization charge reduce every month. So I think H1 averaged 180,000. The run rate's about 150,000, and I think it's very noteworthy that by the end of 2022, on the existing assets we have, the monthly depreciation and amortization charge will be down to £60,000 combined. So you can see that a lot of the assets we already invested in are becoming fully depreciated and are still quite happily employed in our business, earning us money.
Absolutely.
So, I think that's one sort of observation worth making. I think the other thing, and I think the question is absolutely right, that we've got to carefully consider where we deploy capital, and I think we're very much now going to be about fewer sites with much more impact that move the dial and can be a core part of the attraction, the overall attraction, the partners' location, rather than being when we started, we were very much, kind of ancillary revenue and really a bit of a sideshow. And we want to get away from that. So, yes, the business is capital intensive and in that regard, but we're not going to chase headsets. We're going to go for quality over quantity. I just wanted to pick up on another related sort of matter. Now that we've kind of got to what Martin described as the tipping point, I think it's worth just thinking about the following very, very simple, hopefully a very simple example. We hope or we expect on the sites that we install to get payback in no more than a year. And I'm just going to use very simple numbers for illustration, because I think it really shows the accretive impact of doing good new sites. If we invested, for argument's sake, £1 million of capex in new sites, we'd expect to get a contribution back of £1 million in the first 12 months to give us our cash money invested back. But what that is going to give us, if you think about it, is even if we depreciate that equipment over 3 years, even if we stayed with that policy, that £1 million is going to give us 700,000 drop straight down to the PBT level. So, per annum. So I think, what the tipping point and the sort of operational gearing of our business with the nature of our business, I think is something that, is really, really important for us to consider and, should see us start to really fuel growth, not only at the EBITDA line, but down at the PBT line as well. Martin, I don't know.
Yeah, thanks, David.
Does that answer?
Well, I think it answers.
related
I think it answers Anton's question, and I think also his second question about, where are we putting sites and how do we evaluate sites? And we look at sites very, very carefully. And I think, as David alluded to, this business really has come of age. When we first started this, we were creating a new market that just didn't exist. So as a consequence, it's hard to convince somebody to put something in that nobody else has ever put in on a global basis. As we start putting in sites at Clearwater and at Sea Life Orlando and Mandalay Bay, we now have real exemplars of what a theatre looks like. And now we actually install pre-show areas, whether they be tracking sharks or taking pictures of yourself in a shark cage, or looking at the dissection of whales. We can do all of that in a very immersive way, and I think this has really allowed us to become an integral part of these faculties. And the more we integrate with the faculties, the more we become part of the fixtures and fittings of that site, whether it be from a staff perspective or from a visitor perspective. So I think we're spending a lot of time now on diligencing things. We've got the cash, we're generating the cash, and this is about being selective in what we're doing. So just sort of moving on to some other questions. Alan F has asked if 28,000 units is sufficient and can we order more? The simple answer is we have planned this with military precision. We've looked at what we can actually afford to buy and what we can afford to sell. That we manufacture in China, so the simple answer to your question is no, we can't get any more. Especially with global logistics in time. David BS is splitting out partner shares of revenues has clearly confused new potential investors and probably deterred them. Could it not be presented more clearly? I think this is how we've always presented the numbers right from day one, but David can answer that.
Yeah, well, I think the observation is clearly a fair observation. I think it has confused people. We've seen that from the boards and people that we've spoken to. I think we've got to do a better job of engaging with a wider group of investors and making it clear that addressing the point that David B raises. I think it has caused confusion, and I think we're now trying. I mean, there are limitations, I guess, in statutory accounts how we can describe things, but I think we can do a better job of making it plain and simple. And I think we'll always try and do that and be transparent. So I think it's a work in progress, and I think we're conscious that it has been an issue. I just wondered, there was one point, Martin, just going back to the site installations. I saw another question that asked, would we raise more money to do those? I mean, Martin and I, as substantial shareholders, do not want any further dilution.
No, and we've planned, and it's very much in our radar. We're looking at probably, we think somewhere in the region of 150 additional headsets for next year. We can see that's doable out of the cash that's being generated, and this is about being selective with those installations. So the simple answer is no, we don't see that on our horizon.
I think there was a related question: would we consider debt? I think we would if it was on the right terms and we needed it to accelerate growth.
But I think when we're getting payback of these sites in sub 12 months on sort of 3-year deals, then debt can often make sense if we want to accelerate the business. But I think our plans, what we've got in train, we can do within cash flow. Obviously, the logistics issue is a challenge from China. We've got that in hand, or as in hand as you possibly can do. We've got ships landing in LA. They actually landed today with stock, so they'll be cleared customs. And they'll be in the warehouse in the next 2 or 3 days. We've got another boat that's due in next Friday, and then the final consignment we will send via air as air freight gets cheaper in the run up to Christmas. So we're, yes, it's a challenge. We think we've got it in hand, and we're dealing with it. In terms of the sort of capital strain that the Zoo product puts on the business next year, we just see this as it's just another installation, and it's a much bigger market. The footfall at zoos is in many cases a lot bigger, well over 1 million, sometimes running into 2 2 to 2.5 million visitors per annum. So we see actually putting sites into zoos is the right thing for us to do. And as we put those in on an upsell basis, we know roughly what percentage we're seeing of those conversion. So a percentage of the same percentage of a larger number will actually deliver us more revenue and more profit.
I think the business as a proposition for a lender is now in a completely different place than it was, I guess, even before we entered the pandemic, because, we are now looking at funding growth. No lender, lenders are much more disciplined than they used to be. No lender wants to fund losses. They're not in that business anymore, or we should all hope that they aren't. But I think now that, we've got a demonstrably profitable business that can generate, strong operating cash flow, I think, we are in a different place. But, I think we've got to be measured about things. We're not going to chase installations just for the sake of doing installations.
Yeah, absolutely. And I think in terms of margin on our HPE product, we aim after everything, acquisition costs and all the rest of it to sort of be around sort of 25% margin contribution. So, you can work that out from there.
And that's after product cost, marketing, and fulfillment.
Absolutely.
Yeah.
So that's straight contribution into the business.
Yeah.
So we're buying the products at the right price. We're shipping them. We've got distribution. We've got acquisition, whether that be through some of our retail partners or whether it be through the likes of Amazon or whatever. And we're marketing very heavily as we go in. The Vodiac product will be available to all Let's Explore customers. It will be made available to them first, and they'll have extensive range of content. So it's very important for us to look after those customers. It will be a completely free download. There'll be no cost. There'll be a number of videos that they'll be able to watch free of charge, and they'll be able to rent additional ones, including the long-awaited dinosaur safari. So that'll be done. Sorry, please can I read the questions? Yes, of course I can. So Heather F, please clarify what products you are making available to previous purchasers. Obviously, we've just done that. As I sort of scoop down to Tim W, when do you expect the new large installation at Sea Life Florida to start operating? Well, it is actually operating now. It's operating in a fairly sort of small and controlled way. We've got additional sort of theming going on as we speak. But it is actually up and operational, and I think that will start scaling even more sort of come this weekend. But if you go there, you can actually go on our sort of experiences now, and it is generating revenue. David H, is there an opportunity to carve out the Uvisan business into a separate listed entity? Would this potential enhance shareholder value as UV sanitation business may not be recognised properly? I think it's a very valid question. I think it's one that we'd like to see more wool on the back throughout 2022, and then take a decision. At the moment, it generates cash for the business. The business is very, very focused on becoming a sort of an immersive entertainment group. So it's a very valid and good question. But I think we'll just sort of keep our powder dry and keep our options open.
Yeah, I mean, I don't think we're emotionally married to being part of the group, forever. I think number one, we've got to build the business into something valuable. I think then we'll have options. But yeah, I think that's a very good idea.
A number of sites stopped trading with IMMOTION. What are the key reasons for that? Do you expect many more discontinuations? I'm not aware of any sites that have actually stopped trading with us. We've got some sites that are closed due to the pandemic, and there may be one or two sites that we have decided to remove our equipment from, but to date we haven't had any partner that I can recall. I don't know whether you can, David.
I think if we've pulled out of any, they've been small and underperforming, and we've chosen to.
But I think it's our choice, not the partner's choice.
Yeah.
So we're not seeing any sort of pushback, and
there's plenty of opportunity to redeploy equipment where we'll make good money.
And we're actually sort of seeing sites wanting more headsets. Look at Sea Life London is a good example where not only have we put more headsets in, they've actually now asked us to move and actually put even more headsets in to a larger location because we're seeing very lengthy queues at that site. And the last thing that any of us want, including our partner, is people queuing up to give us money.
Martin, David, it might be. I was going to say that.
There you go. There's always one more. So, yeah, sort of presence in London's O2, as it's never mentioned. Yes, we do, and it trades very, very well. The reason we don't particularly mention it, we have the London O2 runs as a tower coaster product. Whilst it's great and generates good revenue, and we have a number of them around the world, it's not really our core focus as we go into 2022. Our mission really is, as I said earlier on, when we're sort of creating content, is to focus in on that conservation, to focus in on delivering sort of movies of animals that people can never experience. And I think it's really giving people something, as I said, that one, you can't experience, and also for the faculty itself, the zoo or the aquarium, it gives them the chance to really start talking about endangered species. The swimming with humpbacks was a prime example. You're never going to be able to see that in a zoo. You're never going to be able to see a humpback whale in a zoo. This is a film with their calves, filmed off Tonga. We got a free diver to go down, hold his breath for 5 minutes, and hold a load of VR camera equipment. So it's a unique experience, and I think that's where we really want to focus our time, effort, and energy. And we're seeing great feedback from those. So London O2, important part, but as I said, as we move forward, very much focused on the sort of zoo and aquarium market.
Well, that's it. I think you've taken every single question that's come through, Martin. So thank you very much indeed. And thank you to all those investors that have taken time to submit questions. If any more come through, we'll make those available to the company for their review. Martin, David, I know investor feedback is important. I'll shortly redirect investors to give you their thoughts and their expectations. But I guess before doing so, could I ask you just for a few closing comments just to wrap up, and then I'll divert investors?
Yeah, look, I think as we touched on before, we've been through a torrid time. Not only have we come through that, we've come through, and I think the business is in a leaner, meaner, and sort of fitter state than it's ever been. We are very much on the tipping point. The business has come of age, and I think we're still in this nascent market as we grow this immersive entertainment group, focused on not only locations but also home-based products. I think we're just well positioned to take advantage of what I think will be a booming market in the months and years ahead.
That's great. Thank you, Martin. Thank you, David, for updating investors this afternoon. Can I please ask investors not to close this session, as we'll now redirect you for the opportunity to provide your feedback in order that the company can better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of IMMOTION Group PLC, we'd like to thank you for attending today's presentation. That now concludes today's session, and good afternoon to you all.